Welcome to the deep dive. We're here to cut through the dense corporate reports and pull out the insights you can actually use. Today we are really tearing into the Q3 2025 earnings materials from Marriott International. Now, Marriott themselves called this a time of ongoing global macroeconomic uncertainty. So our mission today is figuring out, well, how did a giant like Marriott actually do under that kind of pressure? Did travel demand hold up across the board, or, did we see things start to split?
That split is, that's really the core story here, isn't it? When you first look, the overall numbers seem okay, pretty steady. But as soon as you start peeling back the layers, you find these really significant differences geographically and also in who's traveling. So we'll focus on synthesizing those crucial bits of information for you, pinpoint where the real growth is coming from, and spoiler, it's mostly not the U.S. right now. And we'll also detail how their strategic moves, things like development and that huge Bonvoy program, are setting them up for 2026 and what comes next.
Okay, let's dive in, starting right at the top, the big picture. Global revenue per available room, RevPAR. It was up, but only just, 0.5% in Q3. Gently. Well, it is growth, but it feels pretty sluggish, doesn't it?
It does feel sluggish, and the numbers behind it show exactly why. They did manage to bump up the average daily rate ADR by almost 1%, so they charged a bit more per room.
Right.
But that increase was almost completely canceled out because occupancy actually dipped, down 0.3%. So essentially, they made a tiny bit more money by charging more for slightly fewer rooms sold overall.
Okay, so if demand is looking that soft, particularly with occupancy actually falling,
Yeah.
how did they manage to post such, frankly, such strong financial results?
Yeah.
Adjusted EBITDA, that's the key number for their operational health, right? It jumped 10% year over year, $1.35 billion. And net income was up 25%.
Yeah, that really showcases the power of their asset-light business model. And this is, I think, really essential context for you to grasp. Marriott mostly makes money from fees, management fees, franchise fees, not from owning the actual hotels.
Right. Less risk, less capital tied up.
Exactly. No massive debt for the buildings, way less risk, none of the huge maintenance costs you get with real estate. So when they can also keep a really tight lid on their general and administrative costs, which they did, dramatically this quarter getting that 10% margin growth becomes, much more achievable, even if overall demand softens a bit.
That structural advantage is definitely clear. Okay, but let's dig into that demand story because, as you said, it's geographically really polarized. Global RevPAR up just 0.5%, but then international markets, boom, up 2.6%. Meanwhile, the U.S. and Canada, which is their biggest market usually, it actually declined, down 0.4%.
Yeah, that's a huge difference. It really dragged down the global average.
So who's propping it up?
It's basically the international traveler driving the whole train this quarter. If you zoom into the specific regions, APAC, so Asia Pacific, but excluding China, was the absolute star performer. RevPAR there grew nearly 5%. Management specifically called out a great mix of strong rate increases combined with really robust demand from international visitors, especially, they said, people coming back from Greater China and also from Europe.
Okay, APAC's strong. What about EME, Europe, Middle East, and Africa? Was that region also strong, or were they facing different issues?
EME saw decent growth, RevPAR up 2.5%, but there's a really important piece of context there.
Which is?
It's all about the comparison period. Q3 last year, 2024, had major events inflating the numbers. Think the Olympics in France, the Euro 2024 tournament in Germany.
Right. Tough comparison.
Exactly. So Marriott estimates that if you adjust for the impact of those huge events last year, EMEA RevPAR would actually have been up closer to 5%.
Wow. Okay. So underlying demand in Europe is actually quite healthy then.
Seems to be, yes. Very healthy.
Interesting. And then Greater China, which often feels like its own separate market, that was flat.
Yeah, flat RevPAR in Greater China. They pointed to sort of ongoing weaker macroeconomic conditions there, plus, and this is a bit unusual, the impact of multiple typhoons hitting the region during Q3.
Oof. Yeah, that wouldn't help.
Not at all. But even with those headwinds, Marriott did say they continued to gain market share in China, so some underlying strength there too. Oh, and CLA, Caribbean, and Latin America RevPAR there was up nearly 3%. They mentioned getting a meaningful benefit from integrating the City Express hotels they recently acquired.
Okay, so internationally, things look pretty good, especially when you factor in those event comparisons for EMEA. That brings us back to the weakness in the U.S. and Canada, down 0.4%. Let's break that down. Who is traveling, and maybe more importantly, who isn't? What's the customer segmentation telling us?
Well, globally, the standout finding is what they called luxury resilience. It seems the high-end consumer is still remarkably insulated from all this economic uncertainty talk.
They're still spending on travel.
They absolutely are. They're prioritizing it and they're paying for it. Globally, luxury segment RevPAR was up 4%.
And for Marriott, that luxury piece is disproportionately important, isn't it? Because of their portfolio mix.
Hugely important. Look, luxury rooms make up 10% of their total room count, but then you add another 42% that are in what they call the full-service premium segment.
So more than half their rooms are at the higher end.
Right, over half their entire portfolio is aimed squarely at capturing that resilient, higher-spending traveler. If those customers keep traveling, Marriott does well. It's almost that simple at the top end.
Okay, so luxury is strong. What about the other main segments? Leisure, business, group travel.
Globally, leisure transient travel actually led the way in RevPAR performance. It was up 1%.
Okay.
Business transient RevPAR, though, was flat, zero growth, which suggests, that the corporate travel recovery has definitely hit a plateau for now.
And group travel.
Group RevPAR actually declined 2%. Now, Marriott attributed this mostly to timing differences, just when major conventions and big events happened this year versus last year.
Right, could just be a blip. But let's zero in again on that U.S. and Canada decline, that mere low 0.4%. If global business travel was flat, where did the specific pain come from domestically?
It seems to have been really concentrated in their select service brands. Your more mid-tier properties, the ones focused on value.
Okay.
And within that, the business transient part in the U.S. was hit even harder by a really sharp drop in government travel, down something like 14% or 15%.
Wow, that's a big drop.
It's huge. And this, I think, is a critical insight for you to take away. When economic pressure builds, it tends to trickle down the chain scales. It hits the smaller businesses, the SMEs, and those more cost-conscious government bookings first. And those are the types of travelers who often rely most heavily on those select service hotels.
So basically, the well-heeled luxury traveler jetting off internationally is effectively papering over the cracks, masking the real softness being felt by, say, the average U.S. business traveler or government employees staying at a Courtyard or a Fairfield Inn.
That's a pretty good way to put it, yeah. That divergence between the high-end international and the mid-tier domestic is probably the single most important finding in all the segmentation data this quarter.
That domestic softness is definitely a concern, at least in the near term. But it also makes it really clear why Marriott is pushing so hard on expanding overseas and moving further up market. So let's pivot to the future then. How are they building their way out of this? What's the pipeline for new rooms look like?
Oh, they are building aggressively. Net rooms grew 4.7% year-over-year in Q3, and they expect full year 2025 net rooms growth to get close to 5%.
That's pretty rapid growth.
It is, and what's really striking is the sheer scale of their backlog. The development pipeline hit a new record, over 596,000 rooms waiting to be opened at the end of the quarter. And just to give you a sense of momentum, over 250,000 of those rooms are already physically under construction.
Wow. And I assume, given the demand trends we just discussed, that pipeline is heavily weighted towards international markets to counter that U.S.-Canada softness.
You assume correctly. The global focus is unmistakable. Over half of all the rooms in that massive pipeline are located outside the U.S. and Canada. And another really big factor driving their speed is conversions.
Taking existing hotels and rebranding them.
Exactly. Instead of building brand new hotels, which takes years and huge investment, they're converting existing properties to a Marriott flag. Conversions accounted for roughly 30% of both new signings and actual openings in the first 9 months of the year.
Why is that conversion number so strategically important? What does it signal?
Well, it signals that hotel owners see real value in plugging into the Marriott system. They believe the revenue boost from Marriott's brands and loyalty program, plus potential cost savings, outweighs staying independent or with another flag. For Marriott, it's crucial because it means faster, more capital-efficient growth. Owners are basically choosing to skip the risk and the long timeline of new construction and just immediately tap into Marriott's ecosystem. It lets Marriott grow its footprint much more quickly.
Makes sense. And they're not just adding rooms, they're also adding new types of experiences, right? There were a couple of new brand launches and that big acquisition.
That's right. They're trying to fill specific gaps. They launched the Outdoor Collection by Marriott Bonvoy. That includes things like postcard cabins and trailborne hotels, clearly targeting that booming demand for, unique outdoor experiential stays.
Capturing the Instagram crowd.
Sort of, yeah. They also debuted series by Marriott in the U.S., which seems aimed specifically at converting existing independent select service hotels, bringing them into the fold. And then the big one, they completed the acquisition of citizenM in Q3. That was about $355 million, plus some potential earnouts later.
And that added.
That added 37 open, trendy, select service hotels, almost 8,800 rooms to their system, all in one go. A significant boost, particularly in that select service space.
Okay, let's switch gears slightly to the financial engines that really power this whole operation, starting with the loyalty program, Marriott Bonvoy.
Right, Bonvoy. You could argue it's their single most powerful long-term strategic weapon. Membership grew again, now standing at nearly 260 million members globally.
260 million.
Yeah, just pause on that number for a second. It's staggering. It shows the kind of leverage they potentially have over a huge chunk of the traveling public in their future booking decisions. And loyalty penetration, the percentage of stays booked by members, remains incredibly high. 75% in the US and Canada, 68% globally. Members are driving the business.
What's the financial impact of all those members earning points?
Well, the liability on Marriott's balance sheet for all those points earned because they represent future free stays, or redemptions, increased by $301 million just in the first 9 months of 2025. And that leads us perfectly into the other huge financial engine, the co-branded credit cards.
Ah, yes, the Amex and Chase cards. Critically important, right? Because that revenue stream helps fund the loyalty program itself.
It does more than help fund it. It's the absolute backbone. Globally, fees from those co-branded credit cards rose 13% in Q3. And here's the crucial fact you need to understand. Payments from those credit card partners account for more than half of all the funding for the entire Marriott Bonvoy program.
More than half. Wow.
Yeah. And significantly, the banks Amex and Chase actually pay Marriott a higher amount per point than the hotel owners themselves contribute for points earned through stays.
So the cards are incredibly lucrative. And the big U.S. deals for those cards are currently being renegotiated, aren't they?
They are. This is a massive point of focus for Marriott right now. The main U.S. deals were originally signed way back in 2017, extended a bit in 2020. They're in active talks now and expect new, presumably improved deals sometime in 2026.
And Marriott must feel they're in a strong negotiating position.
Extremely strong. Think about it. Since that 2017 deal was signed, Bonvoy membership has more than doubled, went from 110 million members up to today's 260 million. Plus, the number of co-brand card accounts and the total global spending on those cards are both up around 80%. They have way more valuable customers for the banks now.
And they cleverly maintain deals with both Amex and Chase, right? The dual issuer strategy.
Yes, that's key too. It gives them access to different complementary customer bases across the credit card market and ensures really broad coverage. It also probably gives them a bit more leverage in negotiations.
Okay. Powerful loyalty, lucrative cards. We also touched on financial discipline earlier. Yeah. That G&A expense line actually declined 15% year over year while they're growing so fast is pretty remarkable.
It really is. It shows they're managing to invest heavily in future growth, the pipeline, the tech, while also rigorously controlling their current operating costs. That 15% drop in general, administrative, and other costs came from a mix of things, lower compensation costs, apparently, but also the real benefits flowing through from those efficiency and productivity initiatives they kicked off last year. They're squeezing out costs while building for the future. Very disciplined.
Right, maximizing that margin. Okay, let's look ahead then. What's the guidance for the rest of this year and into 2026?
So for the immediate future, Q4 2025, management expects global RevPAR growth to pick up a little bit. They're forecasting 1% to 2% growth. And they expect the pattern to continue. The higher-end chain scales, luxury and premium, should keep outperforming the lower-end ones like select service.
And for the full year 2025?
They kept their existing guidance. Still expecting full year 2025 RevPAR growth to land somewhere between 1.5% and 2.5%.
Okay, steady as she goes for 2025. What about the early look at 2026? More of the same? Or will that U.S. weakness start to bite more?
The preliminary outlook for 2026 suggests pretty similar overall growth, again in that 1.5% to 2.5% range for global RevPAR. However, there's one massive known event that's expected to significantly shift the geographic picture, especially benefiting the U.S.
Let me guess. The World Cup.
You got it. The 2026 FIFA World Cup being co-hosted across North America. Marriott explicitly called this out. They estimate the World Cup alone will add about 30 to 35 basis points, so roughly a third of a percentage point to their full-year global RevPAR growth. And crucially, that benefit will heavily favor the U.S. and Canada, where the games are actually happening.
So a nice built-in tailwind for their currently weakest major market. That's convenient.
Very convenient timing, yes.
Beyond specific events, what else are they focusing on strategically, particularly around technology and innovation? That seems to be a big theme everywhere now.
It's a huge focus for Marriott, too. They talked about an ongoing, multi-year, and undoubtedly very expensive effort to overhaul their core technology systems. We're talking property management systems, central reservations, the loyalty platforms, replacing legacy systems with new cloud-based infrastructure. Their stated goal is to build an industry-leading technology stack.
And AI, is that part of the plan?
Oh, absolutely. They specifically mentioned focusing hard on leveraging artificial intelligence across the business. Things like using AI for content creation, for providing better, faster business intelligence insights to their own employees, their associates. And maybe most interestingly for you, the traveler, they want to ensure that these emerging generative AI platforms, think ChatGPT and similar tools, actually become viable distribution channels. Places where you can get trip planning advice and potentially even book Marriott stays directly. So, if we just sort of pull back and summarize the key takeaways from this deep dive, Marriott's Q3 really relied on two main engines. First, that super resilient, high spending international luxury traveler who basically kept the growth numbers positive overall. And second, the immense strategic leverage they get from that record-breaking development pipeline, especially how quickly they can grow via conversions, combined with the sheer accelerating financial might of that 260 million member Bonvoy program and its credit card partnerships. Those are the pillars right now.
That technology piece, especially the AI angle, is definitely what I want to leave you, the listener, thinking about today. Marriott is explicitly saying they're optimizing their content for generative AI, trying to position tools like ChatGPT as future booking channels. So, how might that industry-leading technology stack they're building fundamentally change how you research, plan, and ultimately book your travel in the next few years? Could we see hyper-personalized trip suggestions popping up, entirely new ways to book that maybe bypass the traditional websites we use now? Something to ponder. That's all the time we have for this deep dive. Thanks for joining us.